You have probably heard people say things like, I bought a stock, the stock market went up, or I invest in stocks. But what exactly is a stock? Is it just a number moving up and down on a screen? Is it a piece of paper? And what are you actually buying when you purchase one? In this video, we are going to explain stocks in the simplest way possible. By the end, you will understand what a stock represents, why companies sell stocks, how investors may make money from them, and what risks are involved. Let's begin with the most important idea. A stock represents a small piece of ownership in a company. Imagine that a company is divided into millions or even billions of tiny pieces. Each one of those pieces is called a share. When you buy one share of stock, you're buying one of those small pieces. For example, imagine a company has 1,000 shares in total. If you own 10 of those shares, you own 1% of the company. You do not personally own 1% of the company's buildings, equipment, or products. Your shares simply represent a 1% ownership interest in the entire business. A person who owns shares is called a shareholder. Even if you only own a very small amount, you are still technically one of the company's owners. Why companies sell shares? Companies often need money to grow. They might want to open new locations, create new products, purchase equipment, advertise, hire more employees, or expand into other countries. One way to raise that money is by borrowing it. However, borrowed money usually has to be repaid with interest. Another option is to sell part of the company to investors. When a company sells shares to the general public, it becomes what is known as a publicly traded company. The company receives money from investors, and the investors receive shares representing ownership in the business. The company can then use that money to continue growing. How people buy and sell stocks. Most people buy stocks through a brokerage account. A brokerage is a company that allows you to place orders to buy and sell investments. When you press the buy button, you are usually purchasing shares from another investor who has decided to sell. These transactions take place through stock exchanges, which act as organized marketplaces for stocks. You do not have to call the company or visit its headquarters. The entire transaction can usually be completed online or through an investing app. Some brokerages also offer fractional shares. This means you may be able to buy part of one share instead of paying for an entire share. How investors may make money. There are two main ways an investor may make money from a stock. The first is when the stock's price increases. Imagine that you purchase one share for $50. Over time, the company grows, earns more money, and attracts more investors. The price of your share eventually rises to $75. If you sell the share for $75, you make a $25 profit. This profit is known as a capital gain. However, the profit is not guaranteed. If the price falls to $40 and you sell, you would lose $10. The second way investors may make money is through dividends. A dividend is a payment that a company may distribute to its shareholders. For example, a profitable company might decide to share some of its earnings with the people who own its stock. Dividends are usually paid in cash, although many investors choose to automatically reinvest them and purchase additional shares. Not every company pays a dividend, and companies that do pay them can reduce or stop the payment. Why stock prices change. A stock's price changes because buyers and sellers are constantly deciding what they believe the company is worth. When more people want to buy a stock than sell it, the price will usually rise. When more people want to sell than buy, the price will usually fall. These decisions can be influenced by many things. The company may announce strong profits, release a successful new product, or gain more customers. News like this may cause investors to become more confident. On the other hand, the company may lose money, face stronger competition, or release disappointing results. This may cause investors to become worried. Prices can also move because of changes in the economy, interest rates, world events, or simply because investors become overly excited or fearful. This is why stock prices can sometimes change even when the company itself has not changed very much. The risks of owning stocks. Stocks can help people build wealth over long periods of time, but they also involve risk. There is no guarantee that a stock will increase in value. A company can lose customers, make poor decisions, take on too much debt, or even go out of business. If the business struggles, the value of its stock can fall. In extreme cases, shareholders could lose their entire investment. This is one reason many investors avoid putting all of their money into a single company. Instead, they spread their money among many different companies. This is called diversification. Diversification does not eliminate risk, but it can reduce the damage caused by one company performing poorly. It is similar to avoiding carrying all of your eggs in one basket. Let's quickly review. A stock represents a small ownership interest in a company. Companies sell shares to raise money, and investors buy those shares because they believe the business may become more valuable. Investors may earn money when a stock's price rises or when the company pays dividends. However, prices can also fall, dividends are not guaranteed, and investors can lose money. Understanding what you own is one of the most important parts of investing. A stock is not just a symbol, a chart, or a number on a screen. It represents ownership in a real business with real employees, products, customers, profits, and risks. Thank you for watching. Please like the video and subscribe for more beginner-friendly investing content.